Most business owners assume that when they lease equipment, the sales tax is simply part of the price of the equipment. That is how it works when you buy a car or make a personal purchase. But commercial equipment financing works differently, and understanding this difference can save your business money and protect your cash flow. When you specifically lease equipment through Jocova Financial, the sales tax is not included in the principal amount that gets financed. Only the equipment itself is financed. The sales tax is added to each monthly payment instead of being rolled into the lease. This is not a technical loophole or a trick. This structure exists for a very practical reason. The equipment you are financing has value. It can be used to generate revenue. And if needed, it can be resold. Sales tax has no value on its own. It cannot be recovered. It does not improve the value of the equipment. Because of this, lenders only finance what actually holds value. They do not finance the tax. This creates an important benefit for you as a business owner. You are not paying interest on the tax portion of the transaction. If tax were included in the amount leased, you would be paying interest on money that provides zero business benefit. By separating tax from the financed amount, your total cost of financing is lower over the life of the agreement. There is another benefit that matters just as much. Cash flow. When tax is not rolled into the financing or required upfront, you avoid a large cash outlay on day one. Instead of writing a big check for tax before the equipment has even started making you money, the tax is spread across your monthly payments. This keeps more working capital inside your business. That cash can be used for payroll, inventory, marketing, fuel, repairs, or simply keeping a healthy cash buffer. This is especially helpful for growing businesses and seasonal businesses. If your revenue fluctuates throughout the year, you do not want to drain cash up front for taxes on equipment that has not yet generated income. This structure helps match your costs to when the equipment is actually producing revenue. There is also a practical accounting benefit. When tax is applied to each payment, your expenses line up more cleanly with each month of equipment use. This simplifies cash flow planning and helps your financials reflect the true operating cost of running the equipment. It also reduces surprises. Instead of one large tax bill at the beginning, you know exactly what your monthly outflow looks like. This structure also makes approvals and budgeting easier. Because tax is not part of the finance principle, the amount being approved is lower. That can help deals move faster and more smoothly, especially when you are working within approval limits or budgets. This is one of the biggest differences between consumer financing and commercial equipment financing. Consumer financing focuses on ownership. Commercial equipment financing focuses on cash flow, asset value, and helping businesses grow without tying up capital unnecessarily. So when you see tax added to your monthly payment instead of included in the financed amount, that is not a disadvantage. It is actually a built-in advantage of commercial equipment financing. It lowers your true cost of borrowing. It preserves your cash. And it aligns your payments with how your business earns revenue from the equipment. At Jocova Financial, we structure equipment financing around how real businesses operate. Our goal is not just to get equipment approved. Our goal is to structure payments in a way that protects your cash flow, lowers your financing cost, and supports your growth. If you are considering new equipment this year, talk to Jocova Financial. We will walk you through your options and design a payment structure that works with your business, not against it.